Something significant is happening across multiple markets at the same time, and most people are only seeing one piece of it. Oil just broke $90. Silver bounced back to $84 after testing lower levels overnight. Vault inventories across major global exchanges are approaching levels that markets rarely see. And geopolitical tensions in one of the most energy-sensitive regions on Earth are escalating by the hour. These are not separate stories. They are different parts of the same story, and understanding how they connect matters more right now than any single price chart. Start with oil, because that is where the most visible move happened today. Brent crude pushed past $90 during the European session, and WTI followed almost immediately, trading just beneath that level. This was not a surprise to anyone who had been watching the underlying variables. For several weeks, the market has been quietly focused on the Strait of Hormuz, the narrow corridor through which roughly 1/5 of the world's daily oil supply travels. Tankers pass through that passage every single day, carrying energy that powers economies across Europe, Asia, and beyond. Multiple energy ministers across the Gulf have now started warning publicly that even a temporary disruption to tanker traffic could send prices sharply higher. Qatar has specifically suggested that prices could reach $120 or beyond if the conflict expands and shipping routes become unstable. That number is not a dramatic guess. It reflects how little spare capacity currently exists in global energy supply. What most people miss when oil moves like this is that it does not stay inside the energy sector. A $10 rise in crude pushes inflation expectations higher across the entire economy, almost immediately. Transport costs rise, manufacturing input costs rise, agricultural production and distribution costs rise. Anything that moves through a supply chain becomes more expensive within weeks. Oil at $90 is not just an energy headline. It becomes an inflation story, a logistics story, and eventually a consumer spending story all at once. That matters enormously, given where the broader macro environment already stands. Inflation in major economies has not fully returned to the targets central banks spent 2 years trying to hit. Wage growth remains elevated in several key labor markets, and consumer spending, which carried economies through the initial post-pandemic period, is starting to show early signs of fatigue. When you layer rising energy costs on top of an economy that is already slowing, the combination policymakers fear most starts to come into view. Rising costs without rising growth. The word markets use for that condition is stagflation, and it creates a policy trap that central banks have very few clean tools to escape. The trap works like this. Normally, central banks fight inflation by raising interest rates, which slows borrowing, reduces spending, and cools price pressures. But higher rates also slow economic activity, which is already weakening. At the same time, if growth deteriorates too quickly, the conventional response is to cut rates and stimulate the economy. But cutting rates while inflation is still running above target only adds fuel to the price pressures you were trying to contain. There is no clean move available. Both directions carry serious costs. That is exactly the environment oil at $90 is reinforcing today. The geopolitical dimension makes this harder to manage, not easier. Military activity in the region has already intensified. Several governments have issued formal warnings about shipping security. Intelligence coordination between allied nations has increased noticeably. Global markets are now monitoring oil infrastructure in the Gulf on an hourly basis, rather than a weekly one. The key point here is not predicting how the conflict develops. The key point is understanding how markets respond to uncertainty around energy supply. When geopolitical risk touches a choke point like the Strait of Hormuz, markets move first and reassess later. The reaction comes before the facts are fully established. Now, shift to silver. Because while oil has dominated the headlines today, something quieter and potentially more significant has been developing inside the physical metals market over the past several months. Western spot silver bounced back toward $84 today, after testing lower levels during the overnight session. The price move itself is not the most important part of the silver story right now. The structure underneath it is. Vault inventories across multiple major exchanges have been falling at a pace that is genuinely unusual for a large global commodity market. The Shanghai Futures Exchange has seen its silver holdings drop dramatically since late last year. Tens of millions of ounces have left those vaults, and what remains is now only a fraction of the levels recorded previously. At the rate those withdrawals have been occurring, inventories at that exchange approach exhaustion within weeks, not months. That kind of timeline for a major global commodity exchange is not normal. Physical inventory is supposed to fluctuate gradually, responding slowly to changes in supply and demand. Rapid drainage like this usually means something real is happening on the demand side that the headline price has not yet caught up with. The COMEX system in the United States tells a similar story. The registered silver category, which represents metal that is actually available and eligible for delivery against futures contracts, has been declining steadily. When that number falls while paper trading volume continues, the ratio between outstanding paper claims and deliverable physical metal begins to widen. 3 major exchanges across 3 continents are showing inventory declines at the same time. That degree of simultaneous tightening is a signal worth paying close attention to. Here is the part of the silver story that most financial commentary still is not connecting properly. The price of silver that appears on screens is driven primarily by futures markets, where paper contracts change hands thousands of times per day, without any physical metal moving at all. But the physical market operates by different rules. Real bars leaving real vaults represent actual supply exiting the system. When physical supply tightens while the paper price remains relatively stable, the gap between what the paper market is saying and what the physical market is doing begins to widen. Eventually, that gap closes one way or the other. Either new metal enters the system to replenish what has left, or price moves higher to reduce demand enough to slow the withdrawals. Markets always find equilibrium, but the path to it can be abrupt. Place that structural situation against the macro environment already described, and the picture becomes more complex. Oil rising. Inflation pressure building again through energy costs. Currency markets showing signs of instability in several regions. Precious metals have historically responded to exactly that kind of environment because they function as monetary alternatives when confidence in currency stability begins to weaken. Gold has already been demonstrating this behavior. Each time economic data surprises to the downside, gold reacts quickly and holds its gains. Silver tends to follow with a delay, partly because it carries both monetary and industrial characteristics. When silver does move in that kind of environment, the move tends to be faster and sharper than gold's. Today's bounce back toward $84 does not confirm a breakout on its own. What matters more than the single-day move is what happens to support structure around the recent lows established overnight. If price returns to those levels quickly and breaks through them, the bounce may have been nothing more than a short-term technical reaction. If those levels hold and price begins building higher consolidation zones above them, that tells a substantially different story about where the next phase of the market is headed. Futures market participation is also worth monitoring closely right now. Open interest across several silver contracts has been declining. Volume is thinner than it was earlier in the cycle. When liquidity thins out like this, price movements in either direction can become sharper and faster because smaller orders have a greater impact on the price. Margin adjustments by exchanges, which alter the cost of holding positions, have also started appearing again. Those changes show up in positioning data before they appear in price, which is why watching the structure of the market matters as much as watching the price itself. Combining everything visible today, the picture is one of several large unresolved variables moving at the same time. Energy prices rising again. Inflation not fully contained. Physical precious metals inventories tightening across major global exchanges. Geopolitical risk now directly touching commodity supply routes. Central banks caught between conflicting pressures with no clean policy path available. When that many variables are in motion simultaneously, price discovery becomes less orderly, and market signals matter more than usual. The next few weeks in the silver market carry more weight than the previous several months combined. If exchange inventories stabilize and withdrawals slow, the market may find equilibrium without a dramatic price adjustment. If withdrawals continue at the current pace while physical demand holds, the structural imbalance becomes increasingly difficult for the paper market to ignore. Watch inventory reports from the major exchanges. Watch how open interest responds to margin changes. Watch how price behaves around the levels established during today's session. Markets leave signals in the data well before the headlines explain what happened. The data is already there. The question is whether you are reading it before or after the move.